Have you ever stopped and asked yourself what truly keeps this world running? What is the invisible, yet powerful foundation that shapes every aspect of our lives? From the roads we travel, the schools our children attend, to even wars and peace. Perhaps you'd think of money, technology, or power. But I want to tell you a different story, a story about something many consider a burden, a shackles, yet it is precisely the greatest architect of the modern world: debt. Take a deep breath and embrace a truth that might astound you. Every nation in this world, from the most powerful superpower to the smallest island, is in debt. The total global debt has surpassed 315 trillion US dollars, a colossal figure, nearly 3 times the size of the entire world economy. That figure isn't merely about loans. It's a tapestry woven from billions of threads of promises, commitments, and expectations. If everyone is in debt, then this world is essentially in debt to itself, a complex web of promises and mutual dependencies. Public debt, viewed this way, is not just a burden but also the foundational architecture of the modern world. To understand the profound nature of public debt, we need to turn back the clock to a cold winter night in 1694 in the Kingdom of England. King William III was facing a costly war against France. The treasury was empty. The army needed food and weapons. In that era, kings often had to sell land, impose heavy taxes, or even borrow from wealthy bankers, who always demanded gold, silver, and specific collateral. But this time, a bold idea emerged. A group of merchants and bankers proposed a groundbreaking solution. They would lend the king a large sum, £1.2 million in exchange for the right to establish a private bank, the Bank of England. In return, this bank would issue government bonds, papers promising to repay the debt with interest in the future. This was not just a loan. It was the birth of an entirely new financial instrument, a standardized and tradable promise. From then on, the Bank of England was not just a bank, but also the government's lender of last resort, and government bonds became the foundation for a new financial system. This event permanently changed how nations operated. The ability to borrow was no longer a sign of weakness, but became a measure of credibility, of the capacity to govern. Instead of sending armies to conquer distant lands for gold and silver, empires could now issue bonds, attracting capital from their own citizens and international investors to finance development projects, armies, or any ambition. Interest rates became the price for stability, for trust. A nation capable of borrowing large sums at low interest rates was considered stable and reliable. It was a new, more sophisticated form of power, based on consensus and trust rather than the violence of the sword. If you think public debt means a nation borrowing money from abroad, you've only seen part of the picture. Look at one of the world's largest economies, like the United States. Most of their debt is not held by China or Japan, as many mistakenly believe. Instead, most of that debt is held by domestic entities, commercial banks, the pension funds where we entrust our future, insurance companies, and most importantly, the Federal Reserve itself, the central bank of the United States. This means that a large portion of a nation's debt is essentially commitments that the nation makes to its own people and institutions. But the story doesn't end there. The global debt system is a complex and cyclical network. Nations lend to each other. Vietnam might buy U.S. bonds, the U.S. might buy German bonds, Germany might buy Japanese bonds, and Japan, in turn, might invest in emerging markets. It's a ceaseless financial dance, a labyrinth of promises, where each nation is both a debtor and a creditor to another. It's like a giant jigsaw puzzle, each piece of financial commitment, and all must fit together for the overall picture not to collapse. So, who decides how much a nation can borrow and at what interest rate? That would be the market and, more importantly, central banks. Central banks, with their unique power, create money by buying government bonds. Sounds magical, doesn't it? But it's true. When a central bank buys government bonds, they are essentially creating new money in the system. This reveals a profound truth. In the modern financial system, money and debt are two sides of the same coin. No money, no debt. No debt, no money. We are living in a world where our currency, fundamentally, is a form of debt. And here's another truth that might trouble you. Public debt today is not designed to be paid off. Sounds absurd, doesn't it? But think carefully. If a nation paid off all its debt, what would happen? Government bonds, considered the safest assets in the world, the bedrock of all financial markets, would disappear. Banks, pension funds, major investors globally hold trillions of USD in these bonds as a safe asset, a refuge for their capital. If this instrument vanished, it would trigger a global economic collapse, an unprecedented crisis of confidence. Therefore, public debt is designed for continuous refinancing. Old loans are replaced by new ones, and interest becomes the rent we pay to maintain stability, for this system to continue operating. But this stability is not always solid. It's more fragile than you think, and it depends entirely on one single thing: trust. Trust in the government's ability to keep its promises. Trust in the value of those promissory papers. When that trust wavers, the entire system shakes, and the consequences can be devastating. We have witnessed this repeatedly throughout history, from the Greek debt crisis that rocked Europe to profound economic upheavals in Argentina or Sri Lanka. When a nation can no longer repay or refinance its debt, creditors intervene, demanding harsh, belt-tightening measures, cuts in public spending, and often causing great suffering for the people. These stories are not just figures in the news. They are lives affected, hopes extinguished, proof of the fragility of a financial system based on promises. And there's another aspect of public debt that we rarely acknowledge: the redistribution of wealth. Interest payments from public debt, though necessary to maintain the system, often flow upwards. They flow from the pockets of taxpayers, ordinary citizens, to large financial institutions, investment funds, and wealthy investors holding government bonds. This contributes to increasing global inequality, as a portion of wealth is transferred from the majority to the minority, creating a cycle where not everyone benefits equally. Ultimately, the modern financial system has truly transformed debt into money. The line between debtor and creditor has become so blurred that it's hard to distinguish. We are living in a financial universe where a delicate balance between promises and expectations is maintained by the most invisible yet powerful thread: trust. It is not merely a burden, but a complex architecture, a ceaseless dance of commitment and responsibility. Understanding the nature of public debt is not to fear it, but to recognize its power and its fragility, so that we can collectively build a fairer and more sustainable financial future for everyone.